Hello students, welcome to EPG Pathshala. I am Navina from HPU. Today we are going to talk about on module statement of changes in working capital and statement of sources and application of funds from paper, accounting and finance. Learning objectives. This module helps to understand the concept of solvency of the firm to meet its long-term obligations. Second, the various ratios like debt equity ratio, proprietary ratio, fixed asset ratio, interest coverage ratio serve the purpose of determine the solvency of the concern. Capital structure of a firm is equally important as it depicts the mixture of debt and equity. The concept of DuPont control chart, which is used by the firm to compare the present ratios and comment on the performance. The term solvency refers to the ability of concern to meet its long-term obligations. The long-term indebtedness of a firm includes debenture holders, financial institutions providing medium and long-term loans. The long-term creditors of a firm are primarily interested in knowing firm's ability to pay regular interest on long-term borrowings. Long-term solvency ratios indicate a firm's ability to meet the fixed interest and costs and repayment schedules associated with its long-term borrowings. Solvency ratios. Now we'll study about types of solvency ratios. Basically, there are 9 types of solvency ratios. First, debt equity ratio. Second, funded debt to total capitalization ratio. Third, equity ratio. Fourth, solvency ratio. Fifth, fixed assets to net worth capital ratio. Fixed asset to long-term fund ratio. Seventh, rate of current asset to proprietors funds. Eighth, debt service ratio. Ninth, cash to debt or service ratio. Now we'll study these ratios one by one. First is debt equity ratio. Debt equity ratio is also known as external or internal equity ratio, and it is calculated to measure the relative claims of outsiders and the owners against the firm's assets. This ratio indicates the relationship between the external equities and the internal equities. Debt equity ratio can be calculated by using formula outsiders funds divided by shareholders funds, or we can use another formula external equities divided by internal equities. The two basic components of the ratio are outsiders funds and shareholders fund. Interpretation of debt-equity ratio. The debt financing used in a business can be measured with the help of this ratio. The proportionate claims of owners and the outsiders against the firm's assets can be indicated with the help of this ratio. The purpose is to get an idea of the cushion available to outsiders on the liquidation of the firm. It is advisable to have an appropriate mix of owners' funds and outsiders' funds in financing the firm's assets. A high debt ratio indicates that claims of outsiders are greater than those of owners. So, it is not considered favorable, whereas from the long-term creditor's point of view, a low debt ratio is considered favorable. As such, there is no rule of thumb, but in some business, a high ratio of 2:1 or even more may be considered satisfactory, and sometimes a ratio of 1:1 may be considered satisfactory. Second type of solvency ratio is funded debt to total capitalization ratio. It establishes a link between long-term funds raised from outsiders and total long-term funds available in the business, that is reflected in this ratio. The two components which are basically used in this ratio are funded debt and total capitalization. Funded debt includes the following items. First, debentures, mortgage loans, bonds, other long-term loans. Total capitalization includes equity share capital, preference share capital, reserves and surpluses, debentures, mortgage loans, other long-term loans. Funded debt to capital ratio can be calculated by using the formula given, that is funded debt divided by total capitalization multiply by 100. There is no rule of thumb, but ideally the lesser the reliance on outsiders, the better it will be. Up to 50% or 55%, this ratio is tolerable, but beyond that, it may create problems to the business. Next ratio is equity ratio. This ratio is also known as shareholders ratio and proprietor ratio or net worth to total assets ratio. This ratio establishes the relationship between shareholders' fund to total assets of the firm. Shareholders' funds or proprietors' funds and total assets are the components of this ratio. Shareholders' fund includes equity share capital, preference share capital, undistributed profits, reserves, and surpluses. And total assets include total resources of the concern. That is, it includes fixed assets, current assets. Equity ratio can be calculated by using the formula shareholders fund divided by total assets. Interpretation of equity ratio. Equity ratio represent the relationship of owner's fund to total assets. Higher the ratio, better it is for long-term solvency position of the firm or company. This ratio indicates the extent to which the asset of the company can be used without affecting the interest of creditors of the company. Now we'll learn about solvency ratio. Solvency ratio is a very small variant of equity ratio and can be simply calculated as 100% equity ratio. This ratio indicates the relationship between total liabilities to outsiders to total assets of a firm. Solvency ratio can be calculated by using following formula as we divide total liabilities to outsiders by total assets. Generally, lower the ratio of current total liabilities to total assets, more satisfactory or stable is the long-term solvency position of a firm. Fixed assets to net worth ratio. Fixed asset to net worth ratio establishes the relationship between fixed assets and shareholders' funds. The fixed assets are to be considered after deducting the amount of depreciation from the respective assets. Fixed asset to net worth ratio is calculating is by dividing fixed assets, that is after depreciation, divided by shareholders fund. This ratio indicates the extent to which shareholder funds are sunk into the fixed assets. If this ratio is less than 105, it implies that owner's funds are more than total fixed assets. When the ratio is more than 100%, it means that owner's funds are not sufficient to finance the fixed assets and the firm has to depend upon outsiders to finance its fixed assets. There is no rule of thumb, but to interpret this ratio, 60 to 65% is considered to be satisfactory. Next ratio is fixed assets to long-term fund ratio. A variant to the ratio of fixed assets to net worth is the ratio of fixed assets to total long-term funds. Fixed asset ratio can be calculated by dividing fixed assets taken after depreciation divided by total long-term funds. This ratio indicates the extent to which the total of fixed assets is financed by long-term funds of the firm. The total of the fixed assets should be equal to the total of the long-term funds. If the fixed assets exceeds the total of the long-term funds, it implies that the firm has financed a part of the fixed assets out of current funds, which is not a good financial policy. If the total long-term funds are more than total assets, it means that a part of the working capital requirement is met out of the long-term funds of the firms. Next ratio is rate of current asset to proprietors' funds. This ratio indicates that the extent to which proprietors' funds are invested in current assets. This ratio is calculated by dividing the total current assets by the amount of shareholders' fund. There is no rule of thumb for this ratio, and depending upon the nature of the business, there may be different ratios for different firms. Rate of current assets to proprietors' fund ratio is calculated by dividing current assets by the shareholders' fund multiplied by 100. Next ratio is debt service ratio. Net income to debt service ratio, or simply debt service ratio, is used to test the debt serving capacity of a firm. This ratio is also known as interest coverage ratio or coverage ratio or fixed charges. Debt service ratio is calculated by using the formula net profit, that is before interest and taxes, is divided by fixed interest charges. Interpretation of this ratio. This ratio indicates the number of times interest is covered by the profits available to pay the interest charges. Long-term creditors of a firm are interested in knowing the firm's ability to pay interest on their long-term borrowings. Higher the ratio, safer is the long-term creditors. A too high ratio may not be good for the firm. One of the limitations of interest coverage ratio is that it does not take into consideration other fixed obligations. Next, cash to debt service ratio. Cash to debt service ratio, also known as debt cash flow coverage ratio. The logic of this ratio is that the interest payments are to be made out of cash inflows of the business and not profits, and apart from interest expenses, sinking fund appropriations on debt. Higher the coverage, better it is, as far as long-term solvency of firm is concerned. Cash to debt and service ratio is calculated as following. It includes annual cash flow before interest and taxes, interest plus sinking fund appropriation on debt tax rate. CF stands for annual cash flow interest and tax. I stands for interest charges. SFD sinking fund appropriation on debt, and T rate of tax. Market test ratio. Market test ratios are of four types: dividend yield ratio, price earning ratio, earning yield ratio, and market value to book value ratio. First, we'll study about dividend yield ratio. Dividend is the amount which is received by the shareholders as a part of profit. This ratio is calculated to evaluate the relationship between dividend per share paid and the market value of the share. Dividend yield ratio is calculated by using the following formula. It is calculated by dividing dividend per share by market value per share. And dividend per share can be calculated by dividing dividend paid to shareholders divided by number of shares. Next ratio is price earning ratio. It is the ratio between market price per equity share and earning per share. This ratio is calculated to make an estimate of appreciation in the value of share of a company. This ratio is widely used by investors to decide whether or not to buy shares in particular company. Price earning ratio is calculated by dividing market price per equity share by earning per share. Generally, higher the price earning ratio, the better it is. Next ratio is earning yield ratio. This ratio shows the relationship between earning per share and market value of shares. Earning yield ratio can be calculated by using following formula. We calculate earning yield ratio by dividing earning per share by market price per share multiplied by 100. Market value to book value ratio. This is your next ratio. It is the relationship between market value per share of a firm and its book value per share. Book value per share indicates the net worth per equity share. The ratio of market value to book value may be used to analyze its stock market position. Market value to book value ratio can be calculated by dividing market price per equity share by book value per share. Book value per share includes equity share capital plus reserves and surpluses minus accumulated losses or total number of equity shares. Leverage ratios. Leverage or capital structure ratios are calculated to test the long-term financial position of a firm. Following ratios are generally calculated to analyze the capital structure of a firm. First is your financial leverage. Second, operating leverage. Third one is composite leverage. Now, first of all, we'll learn about financial leverage. The ratio is considered as trading on equity. The use of a long-term fixed interest bearing debt and preference share capital along the equity share capital is known as financial leverage. Financial leverage is calculated by dividing EBIT, that is earning before interest and tax, by earning before tax. Next, operating ratio. Operating ratio is calculated by dividing contribution by EBIT. Contribution is calculated by subtracting variable cost from sales, and earning before interest and tax is calculated by subtracting fixed cost from contribution. We can further understand this process with the help of the statement. From sales, when we subtract variable cost, we come to contribution. From contribution, when we subtract fixed cost, the resulting figure is earning before interest and tax. Then we subtract interest from EBIT and we come to a EBT, that is earning before tax. And when we deduct tax from EBT, we come to a EAT, that is earning after tax. Ratio of fixed assets to funded debt. This ratio measures the relationship between the fixed assets and the funded debt and is very useful to the long-term creditors. Ratio of fixed asset to funded debt is calculated by dividing fixed assets by funded debts. Ratio of reserves to equity capital. This ratio of current liabilities to proprietors funds establishes the relationship between current liabilities and the proprietors fund. This ratio indicates the amount of long-term funds raised by the proprietors as against short-term borrowings. Next, ratio of reserves to equity capital. This ratio establishes the relationship between reserves and equity share capital. This ratio indicates that how much profits are generally retained by the firm for future growth. Higher the ratio, generally better is the position of firm. DuPont control chart. A system of management control designed by an American company named DuPont Company is popularly called DuPont control chart. This system uses the ratio interrelationship to provide charts for managerial attention. The standard ratio of the company are compared to presence ratios and changes in performance are judged. The chart is based on two elements, that is net profit, which is related to operating expenses. Second, capital employed. This consists of current assets and net fixed assets. This ratio is calculated by dividing profit margin by capital employed and multiply by 100. The efficiency of a concern depends upon the working operations of the concern. The profit margin will show the efficiency with which assets of the business have been used. The profitability can be increased by controlling costs or increasing sales. The return on investments become a yardstick to measure efficiency. Investments turnover can be raised by having a control over investments in fixed assets and working capital without adversely affecting sales. So students, let's now summarize what we have learnt in this module. Shareholders are the real owners of the company, as they have a voting right and they are interested in real sense in the earnings distributed and paid to them as dividend. This is the reason why companies calculate various yield ratios like earning and dividend yields ratios. Dividend payout ratio is calculated to find out the extent to which earnings per share have been retained in the business. All the dividend related ratios are important ratio because plugging back of profits enables a company to grow and pay more dividends in future. The various dividend related decisions depends upon the profit earning capacity of the firm, which is further depends upon the policies framed by the company for financing fixed assets, as it is very crucial problem and there should be proper mix of debt and equity. Leverage ratios are calculated to test long-term financial position of a firm, which helps the company to frame various policies. Thank you.